A business can be running perfectly on a Friday, orders shipping, the plant humming, everyone paid, and be sitting across a table from its lenders on Monday, explaining itself. And the thing that moved over the weekend isn't on the income statement. It's a single ratio, and how close it drifted to a line someone drew in a loan agreement years ago. That ratio is leverage. Most people know the textbook version, debt divided by earnings. Inside a real business, it's something sharper, the distance between how the company is doing and how much room it has to be wrong. Let's build it from the ground up and then walk right up to that line. Start with the word. A lever lets a small force move a large object. A little push on one end lifts something heavy on the other. Financial leverage does that to returns. The whole idea in one line. $1 of equity controlling $5 of assets earns 5 times the return and 5 times the loss. Because the lender is paid first, in full, on schedule, whatever's left over for the owner swings far harder than the business underneath it. So leverage doesn't create value, it concentrates it onto the owners in the good years and the bad. There are actually 2 kinds of leverage, and they compound. The first is operating leverage. It comes from your cost structure. A manufacturer is the classic case. A $40 million factory, salaried crews, equipment leases, big fixed costs that don't move whether you ship a lot or a little. Above break even, every extra dollar of revenue falls almost straight to profit because the fixed costs are already paid. But it cuts hard the other way. When revenue drops, those fixed costs don't. In a high fixed cost business, a 10% fall in revenue can become a 40% fall in profit. The second kind is financial leverage, the debt on the balance sheet. Redline carries about $99 million in debt against roughly $52 million in equity, nearly $2 of debt for every dollar of ownership. That's what we measure with the ratio everyone quotes, debt to EBITDA. Hold on to operating leverage, though. It's what makes the financial kind dangerous, and we'll see exactly why. So, debt to EBITDA. Total debt divided by EBITDA, the company's annual cash earnings before interest, taxes, and depreciation. Redline's $99 million in debt over about $23 million of EBITDA gives 4.33. The cleanest read? At today's earnings, it would take about 4.3 years of every operating dollar to pay the debt off completely. Nobody does that. Interest gets paid, a little principal amortizes, the rest gets refinanced. But the ratio measures the gap between what the business earns and what it owes. EBITDA is the denominator because it's the quickest proxy for the cash available to service debt. Debt is the obligation. EBITDA is the engine that carries it. One balance sheet, 3 different leverage numbers, depending on who's asking. Total leverage counts every dollar of debt, 4.33. Net leverage subtracts Redline's cash, dropping it to 4.15. And senior leverage counts only the debt paid first if things go badly, about 3.3. Same company, 3 answers. They differ because of the stack underneath. Redline's $99 million isn't one loan. $68 million is a senior term loan, first in line and cheapest. $22.5 million is mezzanine, behind it and pricier. About $9 million is the revolver from the liquidity video. The senior lender counts only its own slice, so it sees 3.3, not 4.3, which is why 2 businesses at identical total leverage can carry very different risk. Here's where it all comes together. Redline's loan agreement caps total leverage at 4.5. Redline is at 4.33. That cushion, 0.17, sounds like nothing, and in dollars it nearly is. To stay under 4.5, EBITDA has to hold above about $22 million, and Redline's is $22.9. The gap is roughly $856,000, 3.7% of EBITDA. Now remember operating leverage. a 3.7% drop in EBITDA is small, but with Redline's fixed cost structure, it doesn't take a 3.7% sales decline to cause it. A much smaller stumble in revenue, one quarter where aluminum spikes and the surcharge lags, or two big customers push orders into next period, gets amplified into a 3 or 4% EBITDA miss without much trouble. And the covenant doesn't care why. Report 4.51 at quarter end, and the lenders have rights. Raise the rate, demand collateral, block dividends, even call the loan. The business keeps running, but control shifts. Decisions that were management's now need lender consent. That's what leverage really measures. Not how much debt, the distance between the ratio and the tripwire. So here's the mental model to carry out of this video. A triangle. Total debt, EBITDA, and the tightest covenant. Debt over EBITDA gives you the ratio. The ratio against the covenant gives you the cushion. And the cushion, not the ratio, is what actually governs the business. A company at 2 times under a 5 times covenant has room to breathe. Redline, at 4.33 under a 4.5, runs every decision, every price, every capital project, every inventory build through that covenant, whether it's said out loud or not. That's the lesson. Leverage isn't good or bad. It's a multiplier. What matters is how close the needle sits to the red, and what you do if it crossed. Next in Foundations, the question a lender asks right after this one. It carries this much debt. Can it afford the interest? That's coverage.